Hello traders, Gary Wagner here, approximately 11 o'clock in Honolulu, 4 o'clock in New York on Wednesday, 19th day of March 2014, and this is the daily report for gold and silver. Dramatic downside pressure across the board in the precious metals markets today, with gold leading the way in terms of percentage losses on the day. You can see on the screen currently we are looking at 1328 and change. We've had a low of 1327.30, so we're just on the lows. High 1359.10. Currently it is off over $25 on the day. Dramatic fall from grace when we consider that just a few days ago we were trading roughly at 1390. Silver also under dramatic pressure, but when you consider that gold is off almost 2% on the day, silver is only off about 1%. I say only, but it's down about 20 cents on the day, 28.56. That's what we see on the screen. 20.42 is our low, and 21 even is our high. More on silver towards the end of the show. Traders, before we look at some basic Fibonacci levels to determine where we think this market could go, of course, we exited our long position roughly at 1358, and that was the other day. We got in at 33. Of course, it's actually below that now. But when we look at this market, there's a couple of areas that to me are pretty important, and we can see them even without fib retracement levels. The first is this 1330 area. You can see that we had a lot of, call it congestion or sideways trading activity right in here, and that's before we sparked up. Without a doubt, we've got a band right in here. We've broken through that, and the next set of lows that we want to look at are going to be roughly at 1320. And then we have one again roughly at about 1311. And the interesting thing is we want to see if any of these numbers match, and if so, how they match to a basic fib retracement. Let's go ahead and pull that chart up now. And traders, to do that, I want to pull up this daily chart. If you recall from yesterday's show, we looked at this particular rise right in here, and we determined a couple of different fib levels from this area. Of course, to see that, we're really going to have to blow that up. But just to give you an idea of where we are in terms of our tops compared to our previous tops. But let's go ahead and blow that up so we can really look at some of the numbers that we have coming in. Now, from yesterday, I have changed this just a little bit in that I have added yet another fib retracement level. Let me show you what I'm looking at. We have one fib level that goes from the beginning of the rally roughly at 1181. I believe this is at 1183 or 1184. And then we have those numbers right here on the left-hand side. On the right-hand side, we have some more fib retracement numbers, and that's from a smaller part of the rally, because what I realized is when we look at this rally, it really had two components. First, basically breaking just to below 1300. It trades sideways for a while and then comes up. So our second fib retracement level is from this particular bottom, and this is at 1238 all the way to the top. So when we do that, we get two different levels, two different fib retracement areas. And of course, as you know, my subscribers that have been with us for a while, we look for those harmonics. And harmonics are simply where we have two different fib retracements going from different times and different price points. We're going to the same top, and we look for a match, and the only match we get is we get a 38% retracement, 1313. We get a 50% retracement, and that is at 1314. Traders, what am I thinking? Well, when we take a look at these different levels, we've absolutely broken through a couple of them. This was the first one we were looking at. This is our 23% from our longer fib retracement. It has just barreled right through there, and now it's trading in between these 2 points. Our logical place to look to re-enter the market from the long side, if we're fortunate enough to see the market move down to this point and then find support, of course, is going to be around 1314. This, traders, doesn't surprise me that much, in that when we consider that this market has moved solidly a couple $100 on this most recent rally. Let's go ahead and kind of compress it so we get a better idea of how it relates to these last couple of tops. But considering that we pretty much had a one-way market. This is back in November, end of October. Market is trading at 13, I believe this was around 1360, 1365. This is 1435, 1365. These being our two big rallies that we had. This being our one primary rally that we had back in 2013. Market bottoms, of course, to form that double bottom at 1181. And when we consider the kind of move that we've seen, it doesn't surprise me that we'll probably see some sort of dramatic retracement. And as I said, that could be easily as much as a 38% retracement. And you can see that 38% retracement corresponds, let me line that up, to a 50% retracement. Because we have the harmonics there, to me, that tells me that that is a stronger Fibonacci point, a more natural point for the market to fall to. So we'll have to see. But also, we're trading just below this area, and we have all of this sideways trading action right in here. We're just below it, but we could find support in this area, meaning 1332 ends up being the, although not the lows of the market because our lows are 28. We're currently trading 29.80. But we could see the market, this be the bottom here. So we want to be sensitive to where this market actually wants to find some sort of support. Now, I've gone ahead and pulled up our daily chart. We've talked about this over the last couple of weeks infinitum, but this is our basic Andrews pitchfork. We have our handle, we have our prongs, this being our 0 prong right here, and our 100 mark right here. Of course, they are derived from 3 data points. We talked about that. But here's the key. The key is that there's no doubt the market did exceed this by just a little bit, but not enough to have any kind of clear defined breakout. And in fact, what we have seen is the market genuinely tracked to the top of this channel line and is now headed lower. So we don't have the technical confirmation that we're entering that bull cycle, and without the market really breaking above this point, we cannot with any kind of clarity say that this is a counter trend as opposed to a bullish trend, or a bullish trend as opposed to a counter trend. Right now, if it stays within the confines of this channel right here, we have to, by nature of the technical evidence, say that we're in a counter trend. Because for us to break out of the counter trend, I talked about a couple of different parameters that we really need to see this market take out. This being the last of the 2 parameters. Of course, we met the first parameter, and this is that first parameter. I've gone ahead and pulled back up our daily chart that has this long-standing resistance line. We absolutely broke above that, and we broke above it with a spirit. But at the same time, we have found some real resistance, and the resistance is above this 1335 because that was the prior top, but below this particular top, which is 1435. So for us to really say with certainty in terms of the technical evidence that's there that we are out of the muck, so to speak, and I really believe that we had that potential to see that happen, the fact that we have come down, and when you consider this channel line, how it hit that and then came down. Another study that we've done, let's go ahead and pull this chart up. This has got all of our different fib retracement points, a multiple amount. Let me go ahead and kind of line that up in the screen here. But in this way, you can see that it hit this top. This is 1373. It exceeded that. Here's 1413. It just came shy of that. But we are definitely hitting some real resistance in the market for really the first time since this rally's begun, considering that it began at the beginning of the year. So what do we think this market might do? Well, I don't really think it takes a rocket scientist to answer that question, but if we're going to look at some sort of a wave count, we've got absolutely a strong rally to the upside. I would expect something like 1314, 1313, this 38% retracement level, and then a continuation to the upside. We would know that it's a continuation to the upside because it would absolutely have to break above these tops, and these tops are roughly, I believe, at about 1390, 1388 in that area, but we would absolutely have to take out that prior top to get more confirmation that what we're witnessing here is in fact an impulse phase, and an impulse phase is going to have these upside waves, meaning these strong rallies have to make higher highs on each preceding move. Otherwise, we're looking at a market that's still mired in a downtrend. And right now, the fact that when we look at the channel lines and we just came up off that, we're going to have to wait a little while to get real technical confirmation, and this is the technical confirmation that I would be looking for. So traders, what about silver? As we have talked about over the last few days, daily chart right here, we have a basic long-standing resistance that is coming down from when the market was trading roughly at $50 per ounce. When we carry that through, we can see that without a question of a doubt, we failed to take that out as we did in gold. We took that out, and we took it out with a fever. If you consider that this is the beginning of the year right here, and what we witnessed in gold was a dramatic rise, we saw this market really solidly trade sideways for a while. We had that tremendous rise in which we saw it move off of what, about 1950, stalls just below 22. And as you can easily see, we were never able to take out this long-standing resistance. Let me go ahead and compress it so you can see the entirety of this resistance line. With that in mind, what are we looking for in terms of pricing for silver? And we'd have to take a look at a couple of different studies, but the different areas are 2047 right now. It's at 2058. That to me is going to be a number. And then 2009, 1986. These are the levels going down that we would expect to find some sort of support as this market drops. Dramatically, though, you can see these series of tops right in here. Let's go ahead and kind of line those up. And interestingly enough, you can see that as the market broke, it did it in two basic sessions similar to gold. This is the beginning of the January into February. Of course, in January, as the market in gold was moving higher, we were basically range bound in this particular range between what, 1950 and the high 21s. But you can see how it goes really parabolic in this area. Look at the way that it rises, comes down, tests this area, back in this area. So this is fairly major in terms of the support level. If it breaks that level, the next real level, just in looking at the market, is going to be just above 1950. We're going to remain sidelined. We just pulled a nice profit on our gold trade. I want to sit on the side, see where this market wants to take us, and then from there create our next strategy in the market. This has been Gary Wagner, wishing you as always good trading. We'll talk to you tomorrow for another daily update and review. Bye-bye.